Having a family, it really, really extends your time horizon, 30, 40, 50, 100 years. We're not building wealth for the next week and a half.
Colton Dow manages the wealth of multimillionaires, so I brought him on to teach you how to invest your wealth like they do.
Something to be aware of is if you are starting to get into a large position, I would advise against it near the end of the year. If you're in gold, I probably wouldn't get out of it, but if you're not in gold,
In this episode, Colton shares strategies to predict interest rates, how to find alternative assets to invest in to increase your wealth, and the strategies that eight-figure millionaires use to protect their principal while increasing their yield.
2% might not be that attractive today, but in 5 years' time, that might be 4%. And then all of a sudden now you've doubled that income over 5 years for really doing nothing differently. We're building wealth for decades, not days.
If you want to build a portfolio worthy of handing down to your children and grandchildren, then you won't want to miss this one.
The easiest free way to help out your kids is to...
So I wanted to start this off by kind of painting a picture and getting our listeners in the mindset of what's actually possible through investing, because it can seem like a very slow burn, and sometimes it is, sometimes it's not. Some guys get lucky, some guys don't. But let's take this from a realistic angle of what's possible for a guy that wants to build wealth for his children, and not only for himself, for his wife, but for his dynasty to build this generational wealth. What are some of the vehicles that are open to him when it comes to investing the income that he does have?
Yeah, it's a good thing we're having this conversation now, because 10 years ago there wasn't that many options, or at least it was a lot more kind of difficult to get access. But today, with kind of how technology is advancing, there's a lot out there. So the easy kind of go-to people obviously think of a lot of the time is stocks or some type of shares in a business. It's never been easier to get into something like that. Online brokerages are very cheap to get started. One myth I think investors should be aware of is that you don't need a lot of money to get started. And in fact, almost nobody getting started has a lot to begin with anyway. That's really the point. So it's a lot more accessible now. Yeah, you think about stocks, you think about bonds, a lot of kind of the mainstreams that have been around for a long time. For investors just getting started, good place to start is mutual funds. Easy way to diversify your assets, professionally managed. Exchange traded funds are a lot more popular now with retail investors. Like if you look at even 5 years ago, they weren't really offered through mainstream banks. They were kind of reserved for institutional investors, so hedge funds, insurance companies, endowment funds, stuff like that. But it's becoming a lot more available for people like me and you. And what's nice about them is that their strategies are getting more sophisticated, and not like a sophistication like the managers are kind of giving themselves a job, so to speak. Like they're finding out better ways to actually help retail investors. So those are some of the big kind of starting points that I would encourage to look at first. And then kind of once you start there, there's other avenues that I'd like to talk with my clients about considering as well.
All right, yeah. So let's step back for a second and look at a man's life. Obviously, the most valuable asset that we have is time, and for most people out there, they're trading their time for money, and it's just an unfortunate reality. But let's just say they're in the business of selling their time. How can they get in the business of investing, and what would a man's life look like if he's in that business, so he's using his investments to pay his bills and support his family?
Yeah, I mean, whether you got your own business or you're working for someone else, financial freedom is attainable for everyone. You mentioned at first, time is your biggest ally, and particularly dealing in a family setting, your time horizon is a lot longer than what most people think. So if I'll just start with, say you're working for someone else, because most I think would be. Start, yeah, be aware of what accounts are available for you. Start there, know what your options are. Either you can do your own research online, there's tons of free resources out there, lots of good people to kind of start getting ideas from. And then just, yeah, start taking advantage of them. Know what your employee benefits are too. I think that's an underrated thing that people kind of overlook. Even for myself, I've worked in finance now for 11 years, and I probably honestly didn't really maximize my employee benefits until, I don't know, maybe year 5 or 6 into my career, which, quite frankly is probably a little bit too late at that point, or not too late, but I should have taken it upon myself to do a little bit more research. Stuff like employer matching for certain retirement plans. I know that's a big thing. Yeah, using like health benefits, all of that can really add up to help kind of build that foundational wealth. If you're doing it from a business perspective, I would definitely recommend, obviously, speaking with an accountant and understanding kind of what the best structure is to set up your business. You can make one thing I would too also suggest: try and get the kids involved in the business as best as you can. Um, I think you'll be pleasantly surprised that a lot of the time kids are actually a lot more interested in what you're doing than you think. So, whether that's you're showing them kind of what tools you use for your business, how the business operates, who some of your customers are, kind of get them involved, because I think they'll be a lot more in tuned to the process than you think. And kind of where that comes from is, so I've done a decent amount of volunteering with kids in elementary school, and I'm always kind of blown away at some of the insightful questions that they have, how interested they are in the topic. I mean, if you take a step back, I mean, it's money, right? Kids are a little bit enamored with the idea, so to speak. So yeah, I would suggest getting them involved, and yeah, it's. I think those were a couple places that I would start.
So it's interesting that you say get your kids involved because the way that kids kind of think is they don't really have a huge distinguishing, at least when they're young, distinguishing factor between work and play. So being able to help them see your work is kind of an enjoyable activity to some degree. We don't all enjoy our work, but to some degree, there's some kind of benefit that comes from it. And kids like to play games on the computers, and they number go up. Kids like to see that. If you're playing, I don't know if you ever played a Japanese RPG, but like basically the whole game is exactly the same. It's just that the numbers
Yeah.
get bigger, and so you think something's actually happening. But you said there like we got to take every advantage that we can, and employee match is a great place to start. So what are some other advantages that men can take when it comes to building wealth if they're starting now or starting early?
Yeah, I mean, you can think outside the box too. I mentioned, so easy places to start are, stocks, mutual funds, exchange traded funds, but you can build other assets too. It's stuff like, one of my favorites are like alternatives. So example would be like family heirlooms. Um, what else? You can do like physical assets. So gold's a hot topic right now that a lot of people are considering. Property too is a big one. I know, kind of depending on where you're listening from, property accessibility is a bit different here in Vancouver. It's a bit of a challenge, especially for younger couples to get in. But you can get into property in other ways too. It can be physical, right? If you buy land obviously itself would be cheaper than buying the whole property. If you can even start buying a rental property, help get the more tenants paying for the mortgage, that's a good place to start. But you can also get access to property through what's called real estate investment trusts. So REITs, those are, and they offer a lot of things that physical property don't. So, for example, they are a lot more diversified than if you just bought one home. They are a lot cheaper to get into and get out of than buying your own home. There's no maintenance costs with REITs. So those are some of the other ways that dad or whoever can get access to some wealth building and just let it kind of grow over time. And again, a good idea to kind of get your kids involved and get them aware of what you're thinking of now, because that will kind of shape their thoughts going forward.
And okay, so we're talking about REITs now and different kinds of assets that are possible. A lot of guys like the idea of replacing their income. So let's say every month or every quarter they're getting paid from their investments. So dividends are a very hot topic. But there's the endless debate in the investment world. Do you go for dividends and REITs and getting this consistent income, or do you focus on growth stocks? And I'm not here to ask you which is the better option, but what are some of the advantages of each, and what would factor into a man's decision to purchase dividends versus growth stocks?
Yeah, so, and kind of one strategy I do use with clients, and actually I employ this myself, is what's called a barbell strategy. So you don't necessarily have to do one or the other, right? You can have a certain percentage of your portfolio allocated to income producing investments, right? So we talk REITs, dividends, bonds, and then the other allocated towards growth oriented companies. So I don't know, the Nvidias of the world, technology, stuff like that. Infrastructure is a big growth opportunity right now as well. So you don't have to necessarily do one or the other, but let's talk about the benefits and drawbacks of each. So benefits, obviously, of income producing assets, they are pretty predictable in nature. Particularly, there's a lot of companies out there. They go by the name moniker dividend aristocrats. They've paid dividends for decades on end. They've increased their dividends. That's always a nice place to kind of look. And another kind of, I'll call it misnomer that I would kind of highlight for investors is that they think that just because they buy a dividend today, if it's paying a yield of, I don't know, let's say 2%, 2% might not be that attractive today, but in, I don't know, 5 years' time, that might be 4%. And then all of a sudden now you've doubled that income over 5 years for really doing nothing differently. And you didn't have to trade your time for that. You didn't have to ask your boss for a raise. You didn't have to go to any meetings for that. It's just something that you were rewarded for patience. Drawbacks, I would say, is that at first, sometimes a lot of those income streams don't beat out inflation. So particularly now, kind of inflation's hovering around 2.5 to 3%. If you're getting a 2% yield, you're still a little bit kind of underwater from a net perspective. You still might be getting appreciation on the asset. So overall, you could still actually be up. So that's one drawback. Other drawback too is, like, if you're younger, that's probably not a place that I would start off right away. I would kind of focus more a little bit on the growth side, because you have a lot of time for it to continue to grow. Having said that, let's jump over to the pros and cons of the growth. Pro, obviously, if you're looking at big name companies that you think are going to be around in 10 years, then you're benefiting from all those economies of scale that the company itself is doing the work for. Drawback is, particularly we've seen a decent amount earlier this year, is they are quite volatile. So if you don't necessarily have the stomach for that volatility, if Trump starts spouting off and says he's going to give China, 1,000% tariff, that'll probably hurt the growth stocks quite a bit more, particularly than the income producing assets. So there is a trade-off there. Is you got to have a little bit more of a stronger stomach for the growth. But yeah, that's one thing I would say is kind of look at both and just consider your own personal situation, right? If you're closer to retirement, you'd probably want to gear a little bit more towards the income type of producing assets, right? We talked about bonds, guaranteed investment certificates, term deposits, even some interest like savings accounts. Obviously, those aren't as attractive, but you should always still have some cash on hand for any type of emergency. If you're a little bit younger, millennial, Gen Z, I would kind of still focus a little bit more on the growth because, yeah, easiest way to achieve financial freedom is to use the strongest businesses in the world to your advantage.
Hey, I'm glad you're enjoying the video so far. I thought I'd just jump in and remind you to like and subscribe. It helps me out a lot, and also make sure the algorithm recommends more videos like this to you in the future. So appreciate it if you do. If not, no pressure. And now back to the video. Well said. And obviously, having a stake in lots of businesses is advantageous in the fact that there's diversification, and being able to diversify will help protect the wealth that you've built. So that's also probably a good idea why we split between, or potentially split between, growth and dividends. But does diversification have a place in a portfolio of a man who's trying to build a large amount of wealth, or should he focus more in on something that is more of a specialized knowledge in order to take full advantage of it?
Yeah, great question. So I would say start with diversification. Once you expand your circle of competence, narrow it out. So an example of that is, I mean, easiest example to think of is Warren Buffett. He's got, I think, about 4 stocks in roughly half of his portfolio. So he's a huge holder in Apple, Coca-Cola, can't remember the American Express, I think, is a big holding of his. Now, obviously, he's been doing it for 80 years, so he's got some good experience under his belt. But that's, I mean, that's kind of that's where you progress to, not necessarily where you start. For me, an example of what I did. So when I first started investing on my own, when I was like, I don't know, 17 or 18, I did start with mutual funds at that time. But then what I would do is like kind of look at the top 10 holdings of each fund and then just do my own research on those companies. Because I'm thinking to myself, okay, these are professionally managed by people who have a team of 60 people working under them, researching it, rebalancing it, whatever they're doing. Chances are this is a fairly strong company. Maybe I can learn from it and see what makes it a strong company, right? So I started doing that. I started looking at things like, we talked about dividends. One thing I would highly, highly stress people looking into dividends is look at stuff like the dividend history, look at stuff like the payout ratio, and gauge if that's sustainable, right? Some companies literally have a payout ratio of like 80%. Telcos would be an example. So phone companies, a lot of those aren't sustainable. And I got bit by that myself when AT&T cut their dividend in half. And when that happened, their stock dropped by, I don't know, 20% or so. So I learned a valuable lesson not to chase yield, at least without reviewing if it was, there for the long term, so to speak. So I would say start with diversification. Once you get more comfortable, narrow it down. Now, my investment portfolio, I think I have 15 stocks, maybe 15 right now. My son's education savings plan is in 1 stock. Thankfully, it's doing well, but I know the stock. I'm quite confident it'll be around when he's ready to go to school. But that's all part of me, like kind of doing the research to make sure that the fundamentals are there.
Well, that makes sense. And going back just a couple of steps here, because you are just dropping all the knowledge bombs here. Just going back a couple of steps with, in regards to dividend stocks, obviously there's the potential for dividend reinvestment plans where you take your dividends and you buy more of the stock in question that they come from, oftentimes at a discount, as far as I understand. But then there's the downside to something like a REIT or something that overpays in dividends, and that if they need to expand, they need to raise more capital. And oftentimes they'll issue new stocks or the option to buy new stocks to current investors. What happens to your existing stocks when they do that? Do you get diluted? Do they lose purchasing power? Do they lose dividend payout ratios, or what happens there?
Yeah, so most of the time, what it's called the net asset value, that'll get drop quite a bit if they do have to distribute a big distribution. Another kind of, I'll call it to be something to be aware of is if you are starting to get into a large position, I would advise against it near the end of the year. And I'll tell you why. So what happens is, like, let's say it's a REIT, for example, you put a large position in a REIT in November and they're scheduled to distribute in December. Usually they do quarterly, but usually the bigger one is at the end of the year. And the reason I say be very careful at the end of the year is because you weren't invested in January, so you didn't have that time to participate in the market growth throughout the year. But because you get a distribution in December, that will significantly lower the net asset value, which could actually, I've seen it in cases with investors, bring it below the book value. And I get a call in January saying, well, how is it possible that, it really hasn't moved that much in the last 6 weeks, but I'm below what I put in? And I have to explain that, unfortunately, because of these distributions and how, mutual funds and the like are calculated, that's, they removed assets from the fund. That's the easiest way to think of it. So now it's a little bit, it's worth less because there's less assets in that fund. So a little kind of tidbit for timing is be cognizant if you are considering a large position at the end of the year.
And if you were to downsize that position, is that before or after dividend payment?
So like if you get into it in November and then you go below cost, like would you consider selling, kind of thing?
Yeah. Well, maybe not below cost, but are you saying that the reason that the NAV goes down and therefore potentially the price is because of the dividend payments with the distribution?
Yeah, so it can be. So what happens is we talked about reinvestment. So not every single investor will reinvest the funds, right? A large portion will take the cash out. And so what that leaves the fund with left is the investors that took the cash out of the fund. Well, now there's less assets in that fund. So it's up to the investors that have the cash now. They could reinvest it themselves if they want. My suspicion is they wouldn't, because if they wanted to, they would just have it set up automatically anyway. Now, why I personally like reinvesting the distributions is, number one, it kind of protects you a little bit in that scenario if the fund doesn't perform that well over that time period. But it's free, right? So there's no commission cost to reinvest your distributions. But also too, you can buy partial shares of mutual funds, ETFs. So you don't have to. It's a little bit nicer that way, where you're still investing the full amount. Whereas stocks, for the most part, most online brokers don't let you buy partial shares. So if your dividend's $100, the stock costs $80. Well, you buy one share and then $20 goes to cash in your account. So a couple things to kind of be aware of in terms of distribution. But if it's me, I would suggest most people reinvest it, because that's really, really where you take advantage of the compounding effect, because you just essentially bought free shares.
I also want to go back a little bit because, again, we're packing a lot in here. You were talking about Warren Buffett earlier. Now, one thing that I personally think is often not said enough about Warren Buffett is he took advantage of leverage. Do you think that that is a fair thing to say about him?
For him, yeah. So now this goes to the Robert Kiyosaki and Dave Ramsey kind of diverging philosophies. So Robert Kiyosaki is very, very in favor of debt. I think he recently said he's $1 billion in debt. I don't know if I want to get to that stage, but and then on the exact opposite spectrum, Dave Ramsey is completely against it, doesn't like credit cards, wants mortgages paid off, in 5 years, kind of thing. Now, For the average investor, I would say avoid the debt as much as you can, particularly if you're investing. I'll give you another real life example. So, 2022, markets everywhere were performing quite poorly. I had bought a lot of investments on margin. So basically using the institutions, I was borrowing from the institution to buy more stocks. When the market crashed, I was getting margin called almost every week, which was not fun. So in that scenario, you either have to put more money in or sell your investment. So it can get pretty ugly. Thankfully, I got out really kind of about even, maybe a little bit up. But if I wasn't kind of paying attention to it, it could have got quite ugly. So for the average investor, I would say avoid using leverage to invest. I have I don't know, 200 plus clients, and I can count on one hand how many use leverage to invest. And even when they do, it's for a retirement plan, so they get a check back from CRA, the Canada Revenue Agency, anyway. So they would just use that to pay down a loan. So they're really, even in those very few clients, I'm not using the loan for a long period of time. So yeah, proceed with caution if you plan on using leverage.
Okay, well, let's run through a scenario then. Say somebody, and unfortunately in New Zealand we don't have this advantage because we have 5-year max mortgages. But say somebody has a 30-year mortgage at advantageously they got it at 3% just to keep it at a realistic rate for somebody that might be listening out there. And they're able to pay it off. Let's say they've had some windfall amount that's come in, or they have a salary that might allow them to pay it off in 5 years, as per Ramsey's advice. But instead, they are looking for better ways to deploy that capital. In this instance, when they have such a low amount, or a low rate at which they're borrowing, would it be advantageous for them to then take that money and put it into something like an index fund or a dividend aristocrat or something similar to that in order to increase the amount of wealth that they're able to build over that span of time that the mortgage is for?
Yeah, so now that goes into opportunity costs, and again, this is a very common conversation I had with clients in 2021 when interest rates were rock bottom after the banks cut them to zero because of COVID. So then you look at opportunity costs, and if you're in a 3% mortgage and you can comfortably get 7% average per year on a lot of investments out there, it probably does make sense to maintain the mortgage kind of as is, and then consider looking at different investment options. One thing to keep in mind with that, though, is, and I know kind of viewers from different countries will face different tax consequences, but you want to be mindful of the taxes, that the after tax return that you're getting on that investment, because it varies. So for example, here in Canada, we have what's called a tax-free savings account, and as the name suggests, whatever you put in there, it grows tax-free. So as soon as you want to take money out, there's no tax on it. In that scenario, it's a lot more attractive than if I went into just a regular cash account, non-registered account, and invested there, and it's taxable at whatever my marginal tax rate is. So I would say for the most part, it does make sense in that scenario to look at, getting into the market versus the mortgage. But you got to look at the after tax return, and I think in the U.S., Americans, you can correct me if I'm wrong, but I think you can write off your principal residence interest. Here in Canada, we can't. So that makes a difference into the factor as well.
Yeah, you can't do that here either in New Zealand, so, so we're at a disadvantage there. So we've talked about Buffett and we've talked about some of the strategies that we can do to build more wealth, but you've managed at a certain point over $70 million in assets, so you've seen it all. And one question that is always on the top of my mind when it comes to investing in the kinds of portfolios that different kinds of people build, what is the common factors that you've seen for families, or maybe people that are a little bit older, that are on the pathway to build wealth that they're going to be able to hand down to their kids versus just completely extinguish in retirement?
Yeah, so the one common theme is they got started early. And a lot of that was kind of shaped by the generation before them, so their parents. Experience can be our best friend or our worst enemy. I've seen clients be fully parked in what we call guaranteed investment certificates or GICs or term deposits, I think they is the other term. Um, if you're fully parked in there, it's going to be next to impossible to build your wealth successfully. They just long term they just won't beat inflation. But that's the biggest theme I see is that they started when they were young. Another common theme I see is they don't touch it often. They'll look at it a handful of times a year and maybe make tweaks to it based on what's going on in the market or if they see trouble ahead, whatever it may be. But they don't. They're not day traders. I can tell you that the wealthiest clients I have are not day traders. Um, Actually, the wealthiest clients I have were are business owners. Quite frankly, I had an accountant worth 35 million, and then I had another customer who was the owner of a. I guess at that time it was like a chip manufacturer, and again they were worth about 30 million. So they all started businesses and just let it grow and reinvested in it and didn't really get too fancy outside of that. But yeah, so those are some of the common themes of the clients that I see that are kind of very financially secure.
All right, then. Well, in saying that, you've seen people from all these different walks of life that have managed to build this amount of wealth, be it, six figures or be it eight. So, what is some of the threats to people that will prevent them from getting to the next level of wealth? For example, lifestyle creep, and how will they avoid those things?
Yeah, lifestyle creep. If I could go back to my 20s and talk to myself, I'd have a long, hard conversation. Yeah, so lifestyle creep is definitely one. It's easy to kind of get caught up when you get a raise from work and think that the money will be there forever. Um, it it your raises probably happens once a year. Inflation kind of happens every month. It seems like so. That's one thing I would say just to be aware of is yeah, lifestyle creep. Clients too, I see. Okay, this is actually getting more and more prevalent. Is parents also helping out their children a little bit too much. So yes, we want to support our kids. We want them to be financially stable, but I've seen it kind of shift now that parents are giving. I'll give you a real example. So, client called me a few weeks ago. They want $100,000 out of their investment. It's about 20% of their life savings. So we got about 500,000 left to go. Now, on based on her age and kind of the trajectory of the investments of how they were going, that would probably be suffice. She has pensions and all of that. But 100, like taking out 20% of your life savings to go on a family trip is not advisable in my opinion. She is yeah, so she want yeah, so she's taking her whole entire family, you know, I think there's like 12 people going, something like that, on a big extravagant trip. And she's like, well, this is kind of their early inheritance, is what her thought was. And at the end of the day, it's her money. But had we had a half an hour conversation of kind of how it would affect her ability to kind of sustain her lifestyle now. Another very, very common method, especially in Vancouver, is parents giving their kids down payments for homes. So yeah, property is extremely expensive here, and it's not uncommon for parents to give, 100,000, 150,000 to their kids for down payments on their home. And my hesitation on that is okay. Let's look at your plan first to see how much that will affect your ability to continue the lifestyle that you want to live, because it would be a very, very difficult situation if a parent's been retired for 6 or 7 years and they give their middle-aged kid $100,000 to buy a condo, and then all of a sudden, in another 6 or 7 years' time, they realize, well, they got to go back to work, or they got to eat craft dinner for the rest of their life, whatever it may be. Um, yeah, that's another big thing that I see now being a threat to being able to live the lifestyle you want to live.
Okay, so let me push back a little bit on this because obviously, as men that want to build lasting legacies, we do want to help our children get to the next level. And that might be helping them unlock the potential of property, or it might be, helping them go through college in the case of the poor Americans out there that feel compelled to go through the system. But what are some things that we can do to help our children financially without spoiling them? Or are there some alternative strategies that we can employ in the instance of buying a house, for example, that would prevent the damage to one's lifestyle while still maintaining that elevation of dynastic wealth from generation to generation?
Yeah, so the easiest free way to help out your kids is to teach them about money. Um, have regular financial literacy conversations with your kids. Um, Teach them about checking accounts, savings accounts. Definitely talk to them about interest. It can work for you or against you. Take them with you to the grocery store. Walk them through how you make buying decisions for groceries. Pay for things with cash rather than credit card, because then they can see the physical exchange of something and not just some nebulous piece of plastic that doesn't seem to run out. What else can you do with kids? Bring them to if you have a work with a financial advisor, bring them to the meetings. Get them involved. See the type of conversations that they're having. Chances are, I bet you they have their own questions when they hop in there. That would be a good way to get them involved. What else? In terms of property, I mean, you could think about passing down your own family home, if you have one. You can think about buying communal property. So if like maybe a communal investment property. So if grandparents have some spare money lying around, aunts, uncles, stuff like that, you can look at investment property, pay the mortgage with the tenants, and then when the kids are old enough to go out on their own, look at working some sort of family relationship where they pay rent or whatever it may be, but then at least the asset is there in the family. So yeah, that's another way to think about it. Yeah, start their own investment accounts. Show them kind of what's available to them. Education savings plan is a great way to start. Talk to them about what companies are interest them. Right, I know a lot of my friends too. Some of their parents got them involved in Disney because I mean, every kid is kind of aware of Disney and involved in some way. So they bought shares in Disney. So that's another example of a few ways I think parents can get their kids involved. But I would definitely start with money management skills, because those skills will last way longer than any lump sum inheritance will. And the reason I say that with confidence is um, when you build the money kind of yourself and you understand how to manage it, it's much easier to keep it. Some of the most challenging clients I know that kind of our family offices work with are people that won big inheritances or won the lottery. Um, Oddly enough, those don't seem to last as long as other people think they do, because they don't have the skills to keep it, right. They don't know kind of how money works. um, and it becomes you talk about lifestyle creep. If you want to see lifestyle creep, check out a lottery winner.
Yes, I I watched a documentary on it recently, and yeah, I've seen lottery winners that actually live above their means, despite the fact that they've won the lottery. It's absolutely crazy. So you're absolutely right. Like if you don't know how to manage it, you won't know, you won't be responsible with it. So rather than lump sum inheritances, I think we need to talk more about the mentality around what that inheritance is, because the successful families that manage to pass on wealth, at least from what I've seen, are the ones that see that wealth not as a blessing but as a burden. So how can we shape our children's mentality, not just from young kids but adult kids as well, and to understand that the inheritance isn't necessarily there to give them a free ticket or let them rest on the work of their ancestors, but to be a tool to help them achieve things of their own.
Yeah, of course. So again, this is kind of why I say I think financial literacy and money should be taught in the home because money is a reflection of our values. And I really, really, in my opinion, don't think schools or government should be the ones to tell us what our values are. Our values should be developed at home, and our family builds our own culture. Um, so yeah, that's kind of why I would say start there, and then we talked about earlier about how having a family really, really extends your time horizon. Um, just kind of maybe you can talk about it and say here, here's what mom and dad are using this money for. Here's why we're using it this way, and here's how it's benefiting you. This is why you should kind of continue on to use it this way, right? Whether it's again cultivating a property or building a secure investment portfolio. Um, yeah, so just I would say have that conversation with your kids about kind of what the purpose is, and for those parents that are giving an inheritance kind of while they're alive, call it giving it with a warm hand instead of a cold hand. Um, it lets you be there to support and give guidance, because yeah, like I've seen too many inter family battles where the money's gone and the siblings kind of squabble over what they want to do with it. And yeah, just having that conversation regularly, I think, is an easy way to prevent that.
All right then, yes, definitely keep them in the loop, I'd say.
Yeah.
So we've seen a lot of turbulence in the markets recently, and this is going to keep it a bit topical, but I think this information will apply to anybody regardless of what time period they're living through, because there's always turbulence somewhere, it feels like these days. But for a family that has a low time preference, meaning they're not too worried about their time horizon, how do they know when it's prudent to cut losses and reallocate their capital versus hold on to this investment that might be underperforming or might feel like it's weighing down on them a bit?
Yeah, so you need to build your own investment philosophy. So we talked about kind of the foundations of an investment philosophy earlier. So, um, you know, growth oriented, income oriented, whatever it may be. But basically, what an investment philosophy is, it's a structure that you can refer to of why you're purchasing an investment. So, what are you looking to get out of this investment? What metrics are you looking at to evaluate if it's successful or not? And in times like this, when markets are quite temperamental, just look at the investment and go back to it and say, okay, is this still matching our investment philosophy? Do we still think that it makes sense? I would caution against cutting something just because of a price dip. Like market corrections are 100% normal. They happen on average 2 times a year. Bear markets on average happen once every, I think it's 18 months. So you can expect like over a lifetime to experience, I don't know, 30 bear markets or 20 bear markets where it drops by about 20-ish%. Like that's a part of it, right? Like people get sick, markets get sick, both will recover. So I wouldn't necessarily be, um, kind of trigger happy if the market drops. I'll give you another example. So we talked about it earlier this year a little bit. Trump was quite happy to start throwing tariffs around everywhere. Markets dropped, I don't know, 15% in a month. And then, so on a Monday, there was a leak from the White House saying that Trump is going to delay the tariffs for 90 days. Um, yeah, there's going to be a pause. On the Monday, the White House said, no, that's not true. Tariffs are full going ahead. Here we go. Buckle up. Wednesday, Trump announces, nope, we're going to pause these tariffs for 90 days. What happens? The market goes up 7% in a day, which, like, for context, I think that was the third best day in the last 25 years or something like that. So just because it goes down, you have to understand why is it going down. Now, part of your investment philosophy is you want to review, make sure management still makes sense, and management isn't doing well. An example of that is Starbucks. Starbucks struggled mightily for a long time after Howard Schultz left. Maybe that makes sense to cut the loss then, but yeah, day to day kind of markets don't, or even month to month, I would say, shouldn't really affect an investor's philosophy to buy or sell. The thing to think about is think in decades, not days. Because really, especially from a family perspective, that's what we're looking at, right? We're building wealth for the next, 30, 40, 50, 100 years. We're not building wealth for the next week and a half.
Well said. Well said, yes. It's all about that time horizon. But then we look at things like what's happened in recent history with gold, and that's a very hot topic at the moment. So a lot of people are now, I mean, I've seen, I don't know how, if they're just like sensationalist pictures or what, but lines around corners to be purchasing gold. So is gold a safe place to park your money still in the modern day, or is that something that maybe there's just a bit too much hype around it?
Yeah, I mean, gold itself has no extrinsic value, right? Like you can just buy a bar of gold and it's not going to do anything for you. It's a paperweight. Um, it's getting a little bit more use in industrial, so there might be some value there, particularly with infrastructure being built out for a lot of different reasons. But particularly with what's been going on in the last even like 2 years, really. So last year, a lot of it was institutions buying gold, just to kind of hedge against the US dollar being the world reserve currency a little bit. This year, a lot of it has been investors, retail investors buying gold. Um, it's it's a few things. It's political instability, right? There's still a couple wars going on. It's people kind of getting fed up with tariffs, so they didn't want to have all their eggs in the U.S. dollar basket, so to speak. Um, so I think that's why gold's seen quite a bit of a run up recently. The other thing too is interest rates are coming down on both sides of the border in Canada and the U.S. Gold is not a yielding asset, so if interest rates are coming down, the opportunity to hold gold is actually less, so it becomes a little bit more attractive there. Where I think we might see some trouble with gold is that if this equity market continues to go on its tear that it is, why would I hold a non-yielding asset when I can get, I don't know, there's a bunch of stocks out there that are up 15%, 20%, whatever it is this year, right? So if the equity market continues to do well, then that will kind of outweigh the cost to hold gold a little bit. I mean, it's been a currency for thousands and thousands of years. It's not necessarily going to go away anytime soon. Um, so yeah, I don't know. If you're in gold, I probably wouldn't get out of it. But if you're not in gold, I probably wouldn't get in it at this time. If you're in gold, you're probably done really well, and maybe you can sell off a little bit and reinvest that in other places, particularly if it's become a large portion of your investment portfolio. Um, but yeah, I would say yellow light on gold.
Okay. So you said there that it's good to focus on, well, maybe not specifically, but you were talking a lot about yielding assets. So is that something that should be a primary focus of most people, like buying things that have some kind of benefit or produce something for the world?
Yeah, again, like it depends on age and goals. Like if you're younger, I wouldn't be as concerned about something that's um, going to generate a yield. Like I said, like interest rates are coming down, so that opportunity to get to live off like a savings account or a GIC. It wasn't that long ago where GIC rates in Canada were paying over 5%. Well, it's like, I can get a guaranteed rate of 5%, or I can go in the market and face the volatility and maybe get 7%. Like, it's not that's less of an attractive offer. But now that interest rates have come down, yielding assets are a little bit more tricky to get into. So it depends on age. If you are in retirement, yeah, it probably makes sense to consider a little bit more in a yielding asset, because you've spent your whole life building that financial base. Then to convert it into an income would be probably make sense. But I would just depends on goals and age is the two biggest factors.
Okay, so you've been talking about interest rates a lot now, and there's obviously you've obviously spotted the trend of them coming down. How can people see the trend and what direction it's going up versus down, and what kind of assets make sense on either side?
Yeah, so to spot the trend, just follow central banks meetings. Um, they in North America, I think they meet like, I don't know, 9 times a year, something like that. They might move them. They don't move them often. They might move them 3 or 4 times a year. So that's the way to kind of spot at least of where they're going. Um, I as intro level as it is, I read a lot of Yahoo Finance. I don't necessarily agree with everything on there, but they do they break things down in quite in layman's terms. So I find it helpful to kind of share tidbits with clients here and there. But they'll that's a good place to kind of at least understand where the trends are going. Another good website that I like to use is what's called Trading Economics. They have economic data for every country, and you can click on the country that you're interested in, and it'll tell you what the current interest rate is, what it was last quarter. So there's another way you can kind of view the trends. Assets on either side. So yeah, we talked about it. If it's low interest rates, you don't necessarily want to be in like bonds and stuff like that. Um, very, very. So here's a big linchpin. So technology is very, very dependent on interest rates. The reason being is that their earnings are calculated kind of like years in advance and then discounted back to today's rate. So the tech smash of, I guess it was the end of 2022, I believe. Whenever the interest rate cycle started coming down, tech got hammered really, really bad because they're like I said, their earnings are calculated on a forwards and then discounted back today. So technology is a very, very pendulum style investment. Oh, real estate. Real estate, when interest rates are going up, typically is a good spot to put your money in. Well, interest rates are going down, so I'd say avoid yielding assets. Dividend paying stocks is a good one when interest rates are coming down. Reason being is, okay, let's go back to that example. If I'm paying, if I get a GIC for 5%, but I don't know, Royal Bank of Canada is paying me a dividend of 4%, plus they have to, battle the market fluctuations. Well, why wouldn't I just grab my guaranteed 5% and then, you know, avoid that market volatility of for 4% yield? Well, now if interest rates are down at 2%, all of a sudden that 4% double the amount seems a little bit more attractive. Plus, dividends are at least in Canada, are a lot more tax friendly than just getting an interest rate. So yeah, those are some of the things that I would say. Low interest rate environment. Look for dividend payers. Look for tech. Those are some of the spots. Utilities.
Well, you mentioned tech there. What about crypto and Bitcoin? What place does that have in a portfolio?
Yeah, it's not behaving the way a lot of people thought it would. So a lot of people kind of view Bitcoin as the digital gold. It's not. performing that way at all. It's it is quite volatile. It had a really screaming year so far, but then it fell off a cliff recently just because I guess people were a lot more risk off. Me personally, I look at Bitcoin as a good sentiment indicator. If the price is going up, that tells me that people are willing to take a lot more risks. In that scenario, stuff like small cap companies might be a good place to look at. Um, Private equity firms, that might be a good place to look at. But I don't think we're close to even realizing the benefit of cryptocurrency. Still, I think there's still a long way to go. Like at least here in Canada, there's no retail stores where I can go in and use crypto to buy coffee or anything like that. It's just not available yet. So by a currency, in my opinion, I think it fails still quite a bit. Like when you think of a currency, you think of a store of value. Well, I mean, you can argue it's stored of value, but I don't know. I would argue against that when you look at a lot of other fiat currencies. You look at it as a medium of exchange. We just talked about it. There's really nowhere, at least in Canada, where I can universally go and buy something with cryptocurrency. And you think of it as a measure of value. If I go to the street and ask the average person how much is one Bitcoin worth, are they going to be able to tell me? Maybe, maybe not. So from a currency perspective, I think it still falls short. From an investment perspective, I think there is opportunity, but we're still very early.
Oh, well, it's definitely, at least to me, and still in the alternative asset kind of realm. And I know that you're a fan of alternative assets. I've seen your jersey. So what are some alternative assets that you own, or alternative assets that might be good for a family to put in their portfolio as a more speculative play?
Yeah, so we talked about a few, so like family heirlooms. I'll probably get a lot of heat for this one, but I think luxury jewelry is something to consider, particularly during COVID time. Um, like you look at luxury watches and like those prices skyrocketed like 30% in less than a year. So for me, I have a bit of a asphyxiation for sports memorabilia, movie memorabilia, stuff like that. You can get into alternative assets, like even retail investors, with mutual funds and exchange traded funds too. Like another example of an alternative asset on a bigger scale is infrastructure. So pipelines, data centers is going to be a huge one, obviously, with the rise in AI. It doesn't have to necessarily be a physical asset. You can find alternative assets through the stock market as well. Art. Some of my clients I know, they say it's an investment, but I think it's more of a hobby. Is wine. A lot of clients I know kind of dabble in wine. For my opinion, I think that's a little bit too risky. I don't know how many. Yeah, it's just wine. I think is too easy to fake, in my opinion. But that's another thing that I know clients get into. Yeah, I mean, I've heard clients build a decent amount of like sports cards, um, cars too, muscle cars. So like some of my mechanic friends, they'll buy old cars, fix them up. Um, Classic cars, they for some reason don't ever seem to go out of style, and if you can find the parts and you know what you're doing, I've seen some of my mechanic clients do quite well on those. Um, yeah, there's lots of coins. I've seen clients do collect coins, stuff like that. Um, yeah, lots of different options.
What about fractional shares in private businesses? There's a company here, and they'll let you buy part ownership in farms or vineyards, things like that. What are your thoughts on that?
Yeah, so that's a good way to kind of, depending on if there's any minimums or anything like that, it's a good way to kind of dip your toe in the water. Um, yeah, there are, and I think that just speaks to the demand for alternative assets, right? There's more ways that people can get involved. Um, Having said that, yeah, there's similar stuff for like art that you can invest in, like a fractional piece of famous artist or whatever it is. So I would think that, yeah, that's something to look into. What I would highly, highly stress with that and really any alternative asset is understand what the management experience is with that. So I'll give you an example. If you're ever considering like private credit, right? A business that's not listed on a stock exchange and potentially loaning them money, uh, definitely need to understand what management experience is with that because essentially in a nutshell, they'll be the ones evaluating that credit. And now for me, quite frankly, like I've been in the investment industry for 11 years. Like, I wouldn't feel overly comfortable evaluating a loan to a business because I don't know, that's just not my wheelhouse. I have other focuses on, but that's what I would suggest. And same thing for like if you're doing that for art, right? Like, please don't come to me and ask me what a piece of art is worth because I don't have any, like I would not be the manager for that. Like I don't have any idea. So like um, that is I'll say this. That's one of the drawbacks with alternative assets. It's very, very difficult to get price discovery on them. So I talked about like like a pipeline. How do you evaluate a pipeline? You can say, okay, what's its life going to be? What commodities specifically are going to be moving through this pipeline? You have to be very, very, very good at those pro forma projections that you just that's really, really where management skill would come into play.
There's one thing I wanted to ask you before we close this out, and it's a bit of a personal question, but I think
Yeah.
it kind of gives a lot of insights into your philosophy. Let's say that your son listens back to this in 10, 20 years. What's one thing about building his portfolio that you would want him to know?
I would want him to know that it was intentional. So I chose the investments. I didn't throw a dart at a board and just kind of pull them out of the hat. That I want him to know that I've taken the time to kind of figure out why this investment fits his portfolio. And he's 16 months now. We're a little bit, I think, too early for the money conversations. He only has a handful of words in his vocabulary anyway. But I would want him to know that everything that I've kind of been, all the skills that I've been working towards in finance and investing over the last 11 years, like that's kind of what I'm putting into his portfolio. And it's what I put into my client's portfolio as well. Um, a common question I always get from clients is, well, if it was your money, what would you do with it? And that's not a great question because what I would do with my money and what I would do with your money based on your situation, your goals, your family obligations, your time horizon, your risk tolerance, those are different. Like there's a lot of investments that I'm in that I would again, margin. When I was in margin in 2022, never in my career would I ever recommend someone getting into margin. Um, so it's yeah, it's and I would want him to know that I would want to transfer my skills, my to him. And I'm excited for the day that we can kind of go through, what we've built for him, my wife and I have built for him in terms of his investments and whether it's physical or on the screen, and to kind of just show him and explain to him, here's why you're invested in this. Yeah, it's in your education savings plan, and here's how much we think you'll have by that time. Um, so I would just say for parents to just be intentional, and I think the research is always worth it. And there's been a lot of times when I've spent hours researching an investment for myself and just come to the conclusion like this isn't a good opportunity. There's too much risk there, or the return just isn't worth it. And it's like, okay, I can think to myself, well, I just spent 2 hours, wasting my time, so to speak. But that 2 hours is worth it when, if, as opposed to me just buying that investment and it being a bad investment and losing, whatever it is, 20% on it. And now all of a sudden I've wasted I've wasted time and money on it. So I would say be intentional and, yeah, do the research because it is worth it, and share it with your kids. Be open about it.
That's a great perspective, and maybe one day he will watch this back in 10 years and learn the lessons that you've maybe 20, considering
Yeah.
he's still so young, but learn the lessons that you've bestowed here, and not make the same mistakes, and because I know I've made my fair share as well, and hopefully like that's the point, isn't it? We want to try and minimize, maybe not completely eliminate. I mean, that'd be nice, but it's probably not going to happen. But minimize the number of mistakes our kids will make, and that way we're able to build on it from generation to generation. So thanks for coming on today, Colton. I really appreciate you taking the time and sharing your wisdom with us.
Yeah. Yeah. Thanks for having me, Ben. Great conversation. Look forward to the next time we can have a chat, and had a lot of fun.
For sure, man. We'll do this again soon. Thanks again.
Perfect. Thanks. Take care.
Hey, I'm glad you enjoyed the video. Down in the description below, I'll put Colton's links. Thought I'd mention that now. I'm also going to put a video here that I did with David C. Barnett on how to purchase businesses like wealthy families do. So if you want to build a large net worth, this is a really good strategy to use. And David's a very experienced expert. It was a great interview. Highly recommend checking this video out. Thanks for watching this one, though, and I'll hopefully see you in this one here. Bye for now.